in our last class. This basically, if you remember very well, we have two parties here. We have a party we are calling the lessor. The lessor is the owner of the asset. This is the owner of the asset. If the asset is a building, we shall be calling him who? A landlord. And then, ladies and gentlemen, we have the person that we called what here? The lessee. So the lessee, in this case here, this is the one who is going to get what we call the right of what here? The right of use. He gets the right of use. He doesn't own the asset, but he'll be able to get what we call the right of use. What we shall be abbreviating as ROU. What we shall be abbreviating as ROU, right of use. So he's given the right to use this particular asset, all right, which he doesn't own, all right? And then at the end of each month, for example, or even at the beginning of each month here, he'll be required to pay what we call lease rentals. And then at the end of the day, he'll be required here to stay in this particular, for example, premises for a specified period, So a lease, basically, a lease contract conveys the right of use of an asset to a lessee, which in this case here will be for a specified period, at somewhat here fee. Lease rental has to be paid. And if you remember very well, if somebody, for example, like us at RCM, somebody comes and gives us, in this case here, for example, some space. When he gives us some space, like in our case, we have a lease of 5 years. And we are paying averagely, talk of 200,000 shillings per what year per month. So then when we signed the contract like this, upon signing of the contract, then of course we as the lessees, we have an obligation, we have a very big liability for this landlord, all right? So we say the very first thing you do when you sign a contract, whenever you sign a lease contract, you must first of all recognize what we call a lease liability. You must recognize a lease liability. And to get this lease liability, we normally take the present value of lease rentals. The present value of lease what year? The present value of lease rentals. And I told you, ladies and gentlemen, remember in financial reporting, this present value, you'll not even be given tables. You need to know how to calculate this. So assuming, for example, we have entered into this kind of a contract where somebody wants us to be paying 1 million shillings, at the end, 1 million shillings at the end of each year, for 5 years, for 5 years. So in this case, the lease rental is 1 million shillings every year. At the end of each year, for how many years? For 5 years. And then they have given us the COC. They have given us the cost of capital as what percentage there? Top of 10%. And then now, ladies and gentlemen, we are required here to do something very simple. We are required here, first of all, to know the amount of lease liability we owe. So then how do we get, in this case here, the lease liability? They want us to get the lease liability. Can I give you 2 minutes? Somebody should be able to come and give me the present value of these lease rentals. The present value of the lease rentals, automatically this is what is going to become what year? This is what is going to become my lease liability. Submit. Give me this value. Try your best. See, abracadabra. Is there somebody who is able to give us? Yeah, it's mine. I'm recording. Thanks for the reminder. Let's see whether there is anybody who will be able to give us, because we need to know how to discount. Fortunately, most of us have done what we call financial management. Fortunately, we have been able to know how to discount, and I showed you how to do this in our last class. So is there somebody who can now pull the triggers here and give this a very good shot? Give this a very, very good shot. Remember, COC, COC, stands for cost of what here? This stands for cost of capital. This stands for cost of capital. Remember, in most of the cases here, my good students, for leases, we shall be using what here? In most of the cases, we shall be using annuities, because of the regularity in most cases, all right? So remember, we have got two discounting formulas. We have what we call the PVIF, present value interest what here? Factor, PVIF, present value interest factor. PVIF, this is for the irregular ones. And normally we take 1 plus R raised to negative n, because you're discounting, we subtract up there, right? This is PVIF, present value interest what here? Factor. How about in this case here, PVIFA? How about present value interest factor of an annuity? Present value interest factor of an annuity. Like now, this is $1 million every year, $1 million. So it's an annuity. So if it's an annuity, we shall take 1 minus this simple formula. 1 minus this simple formula. Our simple formula is 1 plus R raised to negative n. And then everything to be divided by R. Everything to be divided by R. All right. So this is present value interest factor of an annuity for those uniform cash flows. Uniform cash flows that are regular. Like this is a lease rental where we shall be paying every year $1 million, $1 million, $1 million. I can see that uniformity. So this is the formula that I'm supposed to come and use. So this will be 1 minus 1 plus R. Remember, R is the required return. Required return to those guys is a return. To us in the company, it's a cost of capital. So this R to us is 10%. And you see 10% is the same as 0.1. So then this one here will be 1 plus 0.1 raised to the number of years. So number of years in this case here, there are how many? This is a lease of 5 years. We're going to enjoy this for 5 years. All right. We're going to enjoy this for 5 years. All right. And then we shall be able to come here and divide everything by our R, where our R in this case here is 0. What here? Our R is 0.1. So is there somebody, ladies and gentlemen, who is able to pick their calculator and please they do the following? They say here 1 minus, open brackets, 1 plus 0.1, you close. And then you say raised. You see, you'll be able to see raised there, x raised to 1. So you say raised to negative 5, and then you say equals first. You say equals first. Before anything, you must say equals. And then at the end of the day, you say divided by 0.1. You say divided by 0.1. So we have Mombi, who is able to give me 3.7908. 3.7908. 3.7908. Mother has confirmed the same. So this is 3.7908. You must be very careful. All of us must use our calculators and ensure that we are able to get these figures. We must use our calculators and ensure that we are able to get those figures. And therefore, the present value of our lease rental, the present value of our lease rental will be equal to what? Therefore, present value of our lease rentals, which will be our, in this case here, lease liability, which will be our lease liability, this will be equal to the annuity of $1 million times PVIFA. Annuity of $1 million times PVIFA. So then this one here will be $1 million, which you are paying every year, times PVIFA of 3.7908. Which will be the same as what here, somebody 3,790,800 Kenya shillings. So this is what we owe this gentleman, the landlord, in total, having discounted. So up to here, ladies and gentlemen, are we together somehow? Up to here, are we together? Up to here, are we together? I can see the number is really growing. Up to here, are we really together? Up to here, are we together? Up to here, we together. Yeah, please try in this case here to communicate with Mwalimu here, to communicate with this ninja. Always try to communicate with this ninja. Great. Thank you so much. Thank you so much. But you see again, another trick that I've always seen the AFR, Advanced Financial Reporting, and of course the Intermediate Financial Reporting examiners doing. These examiners, they'll come and tell you the following. That lease rental is 50,000 per annum. Payable in advance. Payable in advance. Number of years is 6, for example. They'll come and give you the cost of capital. The cost of capital, let's use 10 years, 10%. And then, of course, you'll be required here to give us the present value of lease liability. Or present value of lease rentals. The catchword is that this 50,000 is not being paid in arrears. And now this is the real thing, because you are paying before you stay. Most of us, our rent, how do we pay our rent? We normally pay our rent in advance. We normally pay our rent in advance. So the lease rental is 50,000 per annum, payable in advance. And then number of years are how many? 6 years. And then we have our cost of capital, which is 10%. Remember, 10% is the same as 0.1. And of course, this is our R, which is the required return. So the first thing that I would recognize here while solving this is very easy. You must be remembering this. This is very easy. I will simply go ahead and get my PVFA, the normal one. I'll be able to get the PVFA the normal way. So my PVFA here will be 1 minus this simple formula. And then we divide everything with R. So now remember that this one here will be 1 minus 1 plus 0.1, because R is 0.1. This time around, this is raised to minus 6. And then we come and divide everything with R, which is 0.1. Please, everybody, ensure that you are able to get this using our calculators. Everybody should be able to ensure that we are getting this using our calculators. Everybody, you say 1 minus, open brackets, 1.1, you close brackets. Don't say equals anywhere. Say raised to negative 6. Now you say equals after you finish the numerator. After you finish the numerator, you say equals. And then whatever now you get, you say divided by 0.1. If you don't like that approach, you can use brackets first. So bracket, you say 1 plus 0.1. All right. So you get 1.1 raised to minus 6. So you raise first. And then you come and say 1 minus the answer. 1 minus the answer. Then you say equals. After you say equals, now you should be able to come and say here divided by what here? 0.1. What are we getting, somebody here? We are getting 4.5, 4.3, 553. 4.3, 553 like that. And therefore, the present value of my lease liability, will be this amount of 50,000, the annuity, times now the PVFA, and because in this case here, it's being paid in advance. Because it's being paid in advance, we must include that 1 plus R. Because it's being paid in advance. So this 1 plus R, this times 1 plus R, we only do it whenever you're told that the cash flow is being paid up front. It's being paid in advance. It's being paid up front, or it's being paid in advance. You should always add this 1 plus R. Take care of what here, that term which comes up front. So then this one will be 50,000 times our PVFA of 4.3553 times 1 plus 0.1. So that 1 plus R stands for what here? The advance payments. If you look at your past papers, the FR and the AFR past papers, you'll be able to see what I'm talking about. The examiner, when the examiner wants to twist you out of the race in terms of these leases questions, they'll always put that concept of what here, this is paid in advance. This is paid in advance. So Mumbi is giving me a figure of 23, 239, 542, 239, 239, 239, 500 what year? 542. Is that figure correct? Thank you so much. Thank you so much. So before I proceed, have you been able to pick something here? You know, I wanted to lay a foundation. Because the moment you know how to get this present value of lease rentals, or present value of lease liability, or basically our lease liability, then now we are good students, good kids on the block. On the block, a block called what here? Leases now. So now are we okay? Because I would want to do the question that I was doing in my last class. I had not finished it, if you remember very well. So now are we okay, ladies and gentlemen? Are we okay? I'm not getting responses or even questions. Or even questions. I'm not getting them. I'm not getting them. Are we okay with this? Have we been able to pick some important concepts here before I proceed? Ah, great. At least one student is saying, Mwalimu, yes. Why for yes? We cannot proceed. Thank you so much. Thank you so much. So I'm going to do two questions from your past papers, and those two questions here should really be able to cover the entire thing. Should really be able to cover the entire thing. And this is what I'm looking at. So unfortunately, or fortunately, I can see so many new students, so I can't begin this question just from the middle. The old ninjas will have to allow me to just do it from the very beginning here. So this question is a very, very serious question. We are told the Royal Contractors, we can take a snapshot of this. So Royal Contractors Limited owns an item of land used for construction with a carrying value of 14 million. As at 31st December 2015. The firm won a construction contract and decided to sell and lease back the machine on that date under the following conditions. The selling price is 40. This was also the fair value of the plant. Lease rentals payable annually in arrears amounted to 15,521,200. Lease duration for the machine is 3 years. The economic life of the machine was also 3 years. The implicit interest rate was 8% per annum. So they want us to give them the journal entries to record the necessary transactions in the books of Royal Contractors. Now remember, Royal Contractors in this arrangement, Royal Contractors now is a lessee. Royal Contractors is a lessee. So if Royal Contractor is a lessee, if Royal Contractors is a lessee, if Royal Contractors is a lessee, then the very first step, as we said here, establish the lease liability. Establish the lease liability. That is the first thing you do. If it was a landlord, I would not have done that. So the very first thing you need to do is to come and establish the lease liability. So step number one, give us the lease liability. That is step number one. How do we get this? First of all, this lease liability is always equal to fair value. Always. It's equal to fair value of the asset or market value of the asset. So like in this question, they have told us that the fair value is 40 million. So automatically it means that as this tenant is taking up this space, he should be willing to pay the market value. So the total lease liability will be this 40 million. Because I've been given fair value, I don't need to discount at all. Because lease liability, which is the present value of all the lease rentals, shall always be equal to the fair value of the asset. Like in this case here, they have told us the fair value of the asset. They have told us here, the fair value of the asset. They have told us here, that selling price, you can see this selling price, 40 million. This was also the fair value of the plant. And then you can see lease rentals, and they are payable in arrears. So that concept of multiplying with 1 plus R will not apply here because this is paid in arrears. So in this case here, we have the lease rental per annum. The lease rental per annum. The lease rental per annum. The lease rental per annum is 15,521. Is 15,521. 100 what year? 100. No, 200. Sorry, 200. And remember, this is per annum. And this lease rental will be paid for how many years? Remember, this is supposed to be a lease for 3 years. 3 years. So number of years are 3. Number of years are 3. And then they have also given us the cost of capital or the implicit interest rate. You can see here. This is the rate of return. The implicit interest rate is 8%. Is 8%. The implicit interest rate is 8%. So now I would want us in this case to assume that the fair value was not given. Let's assume that the fair value was not given. So if the fair value was not given, then I would have gotten these. I would have gotten this lease liability. I would have gotten this lease liability by taking the present value of lease rentals. By taking the present value of lease rentals. So then in that case here, this one here would have been this 15,521, 200 times PV for 8%. How many years? 3 years. 3 years. I will not add 1 plus R there because this one is not being paid up front. No, it is only the one that is being paid up front that we normally add the 1 plus R. This one we shall leave it like that. So then my work tonight is very easy. It's well cut. I need to come and get this PV for 8%. So I need to come and get this PV for 8% for 3. So I know the formula is 1 minus 1 plus R raised to negative n divided by R. So then this one here will be 1 minus 1.08 because I know R is 8%. You see, 1 plus 0.08 is the same as 1.08 raised to negative n. So in this case here, our n is 3 years. And then you come and divide this by R. R will be 0.08. Now, why most students in this case here lose track very fast whenever they are being taught, most students don't like using their calculators when they're being taught. So they tend to veer off very, very fast. If I were you, I would take my calculator. Then I punch there 1 minus 1.08. There's a raising function. I have to learn today how to raise here. So you come and say raised to negative 3. Then because you know this over is a bracket on its own, telling you first of all, take care of the numerator. Once I say 1 minus 1.08 raised to negative 3, very well, then I need to come and say equals. And once I say equals, then I will be able to come and divide this by 0.08. 0.08. 0.08. So is there somebody who is able to give us this answer for PV, present value, interest factor of an annuity? Remember, this figure is an annuity because it's a per annum figure. It's a per annum figure. So somebody who is able to give me this PV for 2.5771. 2.5. Can you kindly try this time round to provide this figure like in many, like in 8 decimal places? Let's try that. I know why. Let's try in this case here giving like the whole. Yeah. Let's try giving in this case here like 8 decimal places, or even, I mean, so I know it is 2.7, 2.5, 2.5, yeah, 2.5. Thank you so much. 2.577, 2.577, 2.577, 0.9698, 0.9699. Just like that. Thank you so much. Thank you so much. Therefore, come here, this lease liability will be the number that we have here, which is 15,521, 200 times this ugly figure here, 2.57709699. Is there somebody who is able to give me, in this case here, the lease liability, which in this case, of course, there will be rounding off errors still. But most importantly, whatever figure we get here will be very close to this 40 million. Whatever figure we get here will be very close to that 40 million. Is there somebody who is able to confirm? It may be 39, blah, 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 blah. It's going to be very close to that 40 million. It's going to be very close to 40 million, which confirms that whenever the fair value of an asset is given, then that will be the lease liability. Whenever the fair value of an asset is given, then that automatically will be the lease what year? Will be the lease liability. Will be the lease liability. So you're getting 39,900,000 and something like that. So you're getting this 39 million. We are getting this 39,900,000 and something like that. So we shall assume that this is approximately 14. We shall make that assumption just to go hand in hand with what year, with what IFRS 16 tells us that normally the fair value of an asset will be its lease liability, will be its total liability. So shall take that value to be 40 million, to be 40 million. So in total, as we enter into this house, we owe the landlord 40 million, but you're not going to pay him in this case here like at once. We're going to give this ninja, we're going to give him this money gradually. It could be on a monthly basis or on a quarterly basis, or even on a quarterly basis. So ladies and gentlemen, up to here, somehow, are we together? Up to here, are we really together? Up to here, are we really together? Up to here, are we really together? Are we together somehow up to here? I'm not getting your great responses very fast. Thank you so much. So then, having established a liability, the second thing that we need to do pretty fast is to pay. So go ahead and pay. So number two, in this case here, the lease liability shall be paid. So go ahead and pay it. We normally pay it through a loan amortization schedule. So you prepare a loan amortization schedule. You prepare a loan because now you know you owe. So remember, we have got 3 years. So we have 3 years. Years 1, 2, 3. Years 1, 2, and then 3 like that. So after that, ladies and gentlemen, please come here and give us the opening obligation. Give us the opening obligation. This opening obligation will always attract interest. Remember, interest is normally levied on opening obligation. All right. From there, of course, we shall be able to have our installment, and then we shall be able to have, in this case here, our principal amount, and then lastly, we'll be able to have what we call the closing balance. So even this one can be opening balance. To avoid confusion, let's write this as opening what year? Opening balance. Let's write this as opening balance, like that. Ladies and gentlemen, what do we start with here really? We know our obligation. We know our obligation. We know that our obligation is the total lease liability, the one we said we work with, the 40 million. That's our opening obligation at the beginning of year 1. We are paying our total obligation, which is 40 million. And this is how we shall pay it. We know the installment per year, 15, 5 something. We know the installment per year. Let's pay it. Let's pay it. So we know it's 15, 521, 200. 15, 521, 200, like that. And then remember, we are paying this on an equal basis. Let's pay it. 15, 521, 200. 15, 521, 200. Remember, it can't be that easy. There will be issues like what year? Interest. Interest will be there. So remember, this is our column A. This is our column B. This is our column C. This is our column D. And this will always be our column E. So let's get, first of all, before I continue, I would want to know whether you guys have been able to draw this skeleton. Once you finish drawing the skeleton, can you kindly put your thumbs up like this? Once you finish drawing this skeleton, please put your thumbs up like this live. Live. Please put your thumbs up live. Thank you so much. All right. Thank you so much. All right. So then I want to get the interest. These guys have given me 40. This guy gave me 40 million at the beginning of the year. So I stayed with this money, so I need to give him interest. So interest, of course, will be, I will take here 8%, because 8% is the rate of interest implied. So 8% of the opening balance, 8% of A. 8% of A, 8% of A. So this will be 8% of this 40 million. So 3.2 million. So I write here 3.2 million. 3.2 million. 3.2 million. Thank you so much. Thank you so much. Then, ladies and gentlemen, you guys are bright. You know that whenever we pay an installment, it covers two things. It covers interest, and it covers what year? It covers the principal. So basically, this installment is interest plus principal. Now that I happen to be having interest and I have installment, then to get principal is very easy. What I will do to get principal, I will come and take C, I say minus B. C minus B. Listen, whenever we pay any installment that you pay, it will be equal to the principal. It will be equal to the principal plus who? Plus the interest. It will be the principal plus the interest. Now that I have installment, I have the interest, then to get principal is very easy. To get principal, I will take the installment. Minus what here, somebody? Minus interest. So I will take the installment that I have paid minus the interest. So basically, I'm taking column C minus column boy. Interest is column boy. So in this case here, 15,521, 200 minus 3.2 gives me how much principal? The first principal, somebody here. So 15,521, 200 minus the 3.2 gives me what principal? So a great ninja here called Hope. 12,321, 12,321, 12,321, 200. Thank you so much. So then what do you think am I going to do to be able to get closing balance, my great friends? What do you think am I going to do to be able to get closing balance? Of course, opening balance must be involved. So I'll take opening balance minus what? To be able to get, in this case here, the closing balance. I will take opening balance minus what? Yeah, great. So in this case, remember, your balance can only be reduced by the principal payments, nothing else. Your balance can only be reduced by the principal payments. So in short, for us to be able to get the closing balance, what in this case here we shall do, we shall take the opening balance, you subtract the principal. So you take the opening balance minus the principal. Somebody has already told me that this E will be equal to the opening balance, which is this A, minus the principal here, which is this column D, A minus D. So you take the 40 million, you subtract 12,321, 200. Are you able to give me a figure here? 27,678. 27,678, 800. Thank you very much. 27,678, 800. Then what do you think about the opening balance of year 2? What do you think about the opening balance of year 2? What do you think about the opening balance of year number 2? Opening balance of year number 2. Somebody, opening balance of year number 2 will be the closing for year 1. So we bring this closing for year 1 down here. This will start with the closed with it there. We shall open with it here. So we have here 678, 800. All right. Now this is the amount that we shall use to charge you year 2's interest. So you take this one times 8%. Because always interest will be levied on the opening balance. Thank you very much, Bivlin. Yeah, so 221.4304. 221.4304. All right. Thank you so much. I hope somebody else can also confirm this. What Mumbi is telling me is correct. 8% of this figure, 0.08 times this, 0.08 times this. Can somebody confirm that this great lady called Mumbi, she's giving me the correct figure, 221.4304. Thank you. So once I get the interest, I shall deduct it immediately from installment. This installment here covers two things. And now once I know the interest, then getting the principal will not be a big deal. I will take 15,521, 200 and subtract this to get the principal here. To get the principal here. So 13,306, 13,306, I'm almost finishing. 13,306, 13,306, 13,306, 13,306, 896, 896, 896. Thank you so much. And therefore, closing balance is very easy. Closing balance, you take the opening balance minus the principal. So the figure that you have there in your calculator, you will simply say the opening balance minus that answer. Opening balance minus that answer. You should be able to give us the closing balance for year 2. And we are almost finishing now. We are almost finishing here, which according to Mumbi, it's 14,371. 904. Hii ndio naanguka nayo hapa. Hiyo ndio naanguka nayo hapa. 14,371, 904 like that. So then are you able to give me in this case here the interest here? Are you able to give me the interest for year number 3 as we finish? So we have here 114. 114. Okay. 97.52. 97.52 like that. 149, 752 point something, right? Great. Then, ladies and gentlemen, I will be able to get the principal right away by taking the figure. I don't wrap my figures in my calculator. I will simply say this figure minus my answer in the calculator to be able to get the principal amount. To be able to get the principal amount, to be able to get the principal amount, to be able to get the principal amount. Yeah, so you're getting here 14,371. 14,371, 371, 14,371, 448, 448, 448. And once I get now this figure, straight away I know how to get closing balance. Opening balance minus the principal, and I'm bright enough. I know that these numbers here rarely, especially when they are big numbers like this, rarely will they amortize to 0. But you see, I don't have to show the examiner that I don't know. I know that this thing at the end of the day, even if I'm getting 300, 400, 300 out of 40 million is nothing. That's not Chugunu, it's nothing. So basically here, I should be able to come and tell the examiner that the net closing balance at the end of the 3rd year equals what year 0. If you write a number there like Mombi, like what mother you have there, if you write a number there, then it means that your loan schedule has not amortized fully. You can't get all the marks. So the last one, even if I'm getting whatever number, I shall write inside there what year. I shall write 0. I shall write 0. I shall write 0. All right. Ladies and gentlemen, after that, now I've been able to pay. This thing has amortized to 0. The next thing, then, I'm in business. When I'm in business, I must always think about the impact of this in my financial statements. So the next thing that you will do is to go ahead and give us an extracted income statement, because it can't be like a full income statement. You don't know what sales revenue is out of that premium. No. So you're only doing an extracted income statement. So out of this, we shall now come and do an extracted income statement. So come and give us an extra. So step number 3, I want you to memorize these steps, because this is very popular in your exams. So step number 3, go ahead and give us extracted income statement. Extracted income statement. So remember, we have 3 years. We have year 1, year 2, year 3. Year 1, year 2, year 3. So you're going to have an income because there was a disposal done. And then we have expenses. There are two expenses normally. We have interest paid. We have interest there, interest. And then lastly, of course, we have what we call depreciation. Depreciation. Because now you'll depreciate. You are the one who has the right of use. Now you must depreciate your asset. It's your asset. Because now you have the control aspect here. So we have income, basically will be the gain on disposal. We have here the gain on disposal. We dispose this, remember, asset. Gain on disposal. Gain on disposal. Can somebody in this case say, give me this gain on disposal? That shall book in year one. That shall book in year one. The gain on disposal that shall book in year one. Remember, this asset initially was ours. We sold it. By the time we were selling it for 40 million, by the time we were selling it for 40 million, by the time we were selling it for 40 million, its net book value was 14. The carrying value was 14. So you see, we made a huge profit, really. Huge profit. We sold it for 40 when it was worth 14 in our books here. So then 40 minus 14, that will give us how much? Somebody please give me that figure. 40 minus 14, that will give me a disposal income of how much? A disposal income of how much? 26. Remember, that will be booked on year one. Nowhere here. Nowhere there. Interest, we have our interest here. The first year, so this then has to be 26 million. Just to be consistent. Yeah. Then interest is what we have here. So this is 3,200. Year number 2, we have 221, 4304. Then we have 114, 97, 52, 97, 52, 97, 52. So please let me know whether you guys have been able to reach here. Let me know whether you guys have been able to reach here. When I say my yes, thank you so much. Then we go to depreciation. So depreciation, you need to know your asset value. Depreciation, you need to know your asset value. All right. So depreciation, you need some other working here. You need a working for depreciation here. How do we do this working here? So we have in this case, ladies and gentlemen, a working for right of use. Right of use. So how do we get right of use? To get right of use, we normally take the lease liability. The lease liability, like that. You will add any direct costs. Any direct costs you incurred. So for example, like ourselves, once we leased, ladies and gentlemen, once we leased this space, we leased this space from the landlord at Stanbank, that is as an RCM, you know, there are those direct costs. For example, you need to come and do painting, right? You need to come in this case here and do what here, for example, there'll be some modifications. This is supposed to be a college, classrooms. So there will be, in this case here, what we call what here, you must do so many partitions. You need billboards outside there, right? You need billboards outside there. So all those, so you start with the present value of your lease liability. That's where you begin from. And then now, do we have any direct costs? For example, like you must have involved lawyers for signing of the lease contract. That has to be capitalized. And of course, the other expenses that we shall be seeing here, but most importantly, the one that you should never forget are the direct costs. And then you shall be able to do what you have to add. So then these will give you what you call the ROU. So in our case, we don't have any costs given here. We don't have any other additional cost given here. So basically, in our case, our ROU will be exactly equal to what here? Our ROU will be exactly equal to what here, somebody? To 40 million. Because there are no additional costs. There are no additional costs. So our ROU will basically be equal to the what here? to the lease liability. So remember, this right of use is what will be your asset value. This now will be your asset value as you begin. Why are we calling it an asset? Because the moment Standbank House, they have given us the right of using their space there, we as the lessees, then we shall be able to draw income from students. Students shall be able to pay us fees. So in this case here, we have an asset that you're able to control. And because you're able to control it, the students don't pay the landlord, they pay to us. So remember, an asset is any economic resource that has got future economic benefits. Any economic resource that you are able to control, any economic resource that you own, you are able to control, and you are able to derive economic benefits. And of course, those economic benefits can be measured reliably. Then automatically, that's an asset. So if it's your asset, go ahead and depreciate, but unless you're told otherwise, the depreciation here shall be straight line method. So, and of course, you don't have scrap value. So depreciation here will be 40 million. 40 million, you divide this by 3 years. We divide this by 3 years. So is there somebody who can give me this depreciation per annum? And this is what I'm going to book. This is what I shall book here. So we have here 13, 333. So we have here 13, 3, 3, 3, 3, 3. So like that, 13, 3, 3, 3, 3, 3, 3, 13, 3, 3, 3, 3, 3, 3. And now you are through with your extracted income statement. So these are the numbers that you'll be able to take out your income statement pertaining to your leased asset, pertaining to your leased assets, pertaining to your leased assets. These are the numbers you should be able to take to your full income statement now, pertaining to this extracted income statement. So please ask questions. Feel free to ask questions. Feel free to make contributions. And if you're comfortable, then you can put your thumbs up like this, and then I'll be able to move on to the last section of this question. I'll be able to move on to the last section of this question. Yeah, from Beverly. Beverly, she's telling me, Mwalimu, move on. Do we have any other student who's also confirming the same with a thumbs up? With a thumbs up? Yeah, a good question is being asked there. What if, for example, there was scrap value? Remember, if there was scrap value, say, of $1 million, what I would have done is to come here and say initial cost minus that scrap value of $1 million, I get at 9 million. And then I divide by 3. Yeah, if there was any scrap value, then that is what we do. But in most cases, ladies and gentlemen, for these leases, there will be no scrap value. That's a very good question. All right. So the last one, now that is number 4. The last one, number 4, now you'll be able to give us an extracted statement of financial position. Extracted statement of financial position. Extracted statement of financial position. So give us here extracted statement of financial position. So remember, we have our years 1, 2, 3. So first of all, you start with non-current assets. So the non-current assets, you shall always begin with this leased asset. We call it ROU, right of use. You can just simply put there as leased asset. So remember, at time 0, 1, 2, 3, at time 0, we began with 40 million. But remember, each year we are losing that 13 something. Was it 13,333,000 each year? So then by the end of year 1, what will be the value of our asset? Because we're looking at the end of the years. End of the years. Remember, this is today 40 million. So by the end of the year 1, by end of year 1, yeah, gain on disposal, selling price. Yeah, selling price. You less selling price. Selling price, it was selling price. You less the carrying amount. You know, selling price is the same as fair value. Selling price is the same as fair value, 40 million. Then you less the carrying amount. You less the carrying amount. That's how we got that 26. Oh, gile nauliza, ni gile kwa muulizo kwa juu. Hiyo gain on disposal imetoka wapi hapa? Thank you very much, Irene, for jumping in. So remember, tumeambiwa kwamba this thing was sold for 40 million, right? And yet it had a carrying amount of 14. Look at that gain. So 40 minus 14. 14, which gave us 26. All right. So then I'm being given the first one here. Year one, it will be 26 million, 666,667. And then, of course, year two, the whole of year two is going to lose the same amount. The whole of year two is going to lose the same amount. So if you take this minus this year's depreciation, second year depreciation is also the same. So take this minus second year's depreciation, the same. So I'm going to be left with how much here somebody as the value of the asset, year number 2. 13, 333, 334. This one, even if you're left with 1 shilling, you can't write 1 shilling. We expect the asset to be fully depreciated. We expect the asset to be fully depreciated at the end of the lease life. We expect the asset to be fully depreciated at the end of the lease life. We expect the asset to be fully depreciated at the end of the lease life. At the end of the lease life. At the end of the lease life. Now from there we got the liabilities. So liabilities, I will start with non-current liabilities. Non-current liabilities. So then remember, here you must state a note. You must go there and give us a note. You must go here and give us a note. So what is the note? If payments are done in arrears, in terms of liabilities, we shall always pick the closing balance, and the principal amounts. Closing balance and the principal what here? And the principal amount. Closing balance and the principal amount. These are very, very important note. Please write it in full like this. If, for example, you are a big supporter of Kenya Kwanza, the highlighter should be yellow. So use a yellow highlighter. If you are an Azimio supporter, blue. Yeah, kila mtu na kala yake. Not if these rental payments are being made in arrears, like in our question, they are in arrears. Then for liabilities, we shall have this closing balance and the principal amount. So this closing balance will be for the non-current liability. And this one here will be for the current liability. Current liability. Yeah. So sasa ukishaandika namna hiyo, under non-current liabilities, we have here lease. You will simply write lease. And also under current liabilities, you shall also write lease. Lease, like that. Lease. So remember, here you're going to pick what we call the closing balance. Closing balance, and here you shall pick the principal amount. But now remember, you will start from the second year. You start. The figures you pick will always be from the second year. The figures you pick will always be from the second year. Look at this. And current liability, the lease. Tumesema ndio kwa closing balance. Lakini usianzie hapa year 1, unaanzia year 2. So utaruka mwaka yote hapa, lakini pale unaanza kusoma from year 2. Kwa hivyo kumaanisha hapa lease, hapa itakuwa ni 14,371, 904. Naanzia hapa. Hii hapa ni 0. kumaanisha hata ingine itakuwa 0. Na pia principal amount, unakuja kwa principal amount unaanzia year 2. Year 2. Unasema 13,306, 896, and then this one here, you know, always year 1. 14,371, 448. The other one is 0 because there are 3 years. So I'm so sure I'm to understand, lakini kwanza andika ndio niweze explain better. Andika kwanza ndio explain better. Maliza kuandika, allow me to explain better. Andika and explain better. Why do we ignore the first year? Thank you so much. So let me write this, explain this in a better way. And I'm only going to write the non-current liabilities and the current liabilities. So we have here non-current liabilities. So we start with lease. So we have here 1, 2, 3. So you see, non-current means what? That we are going to take more than a year to pay. Any liability which spans more than a year, then that is not current. Current is what will be paid within the year. So then we know that these are our liabilities, these ones here. So the first non-current liability is the one that is going to take us more than a year to pay. So this one, you see this one here, 14, second year and onwards. So it means that then I should be able to come and book the first non-current will be the long year 2, year 3, even there was year 4. So when it's non-current, you can't begin from year 1. So then we have year 14, 371, 904, and then of course we have this one here, which is 0. The other one is not there. And then now you come and ask yourselves, what about the current liabilities? Current liability. So in this case here, we call these the lease. The lease. So then we will ask ourselves, you know, initially we had 27 million and something, but something must have been paid for us to arrive at 14. Can somebody give me the difference between this and this? Can somebody give me the difference? Somebody take here 27, 678, 800. 800, you say minus 14, 371, 904. Somebody please give me that. Now usichoke tafadhali. Usichoke tafadhali. Sema to 27, 678, 800 minus 14, 371, 904. How much are we getting there, somebody? Usikachoke tafadhali. Usikachoke tafadhali. Yeah. 13, 30, 13, 30. So we have here, so this is 13, 30, 13, 30, 68, 96, 68, 96, 68, 96. So then it means that this that has been paid within the year is what is our current. Is what is our current. And then again, to get the next current liability, you will consider this and this. So what was paid in between here, it will be this 14, something like that. To avoid all that confusion, we came up with a very easy way for our students here to remember. We came up with a very easy way for our students here to remember, because you see, in an exam, you don't have the luxury of time. You don't have the luxury of time. So like we said, on non-current assets, you go and pick the closing balance, I mean. Pick the closing balance, but now from which year? That is the only trick. You pick the closing balance from year 2 onwards. So you pick the closing balance from year 2 onwards, like this, 14, 371, 904, onwards 0. Here there's nothing. For lease current liability, pick in this case here the principal. Again, from where? From where? From year 2 onwards. Pick without even reasoning. You go and pick the principal year, but from year 2 onwards. So we have here 13, 306, 896. This will be 14, 371, 448, whatever. And then of course there will be a 0 there. So ladies and gentlemen, up to here, have we been able to appreciate something, especially the shortcut? I'm not really interested in the long way, because even myself, where I work, I practice international financial reporting standards every day. And for sure, we use these shortcuts. Because, I mean, where will you get that luxury of time in this case? You have to do what? You have to start. I mean, no. Great. So then I would want you to do me one favor. I would want you to go and watch, because now what I'm left with here is to show you the journal entries. How do we pass journal entries? For example, whenever we have like this depreciation, we shall be debiting, for example, the depreciation, we create accumulated depreciation. All right. When, for example, we sell this asset, what entry should we have? So I'm left with the journals, and then of course getting to show you like that, what if, in this case here, this asset, the lease rentals were paid in arrears. At least you know that there is a 1+R somewhere. But you don't know how to do a loan amortization schedule for the ones that are paid in arrears, which I'll now be able to show you. With a little time left here, nothing much I can do, because I also happen to be having another class at exactly 8 p.m. I beg to disappear. Much love from this ninja to you, my little ninjas. Bye. So I move aside, okay. I move aside. All right. Thank you so much. Adios, yes. Great. Yeah, big ninja, yes. Great. Thank you so much. Good night. See you. Remember, this class, we normally meet 4 times a week. It's a special class. We meet 4 times a week. And then I'll be able to give you access to LMS, and I'll be telling you the videos to watch. Especially this lower level FR. I've been an examiner for long. I know, of course, nowadays I've become a chief ninja. I can't examine anymore, but I know those areas to be knocked. This is the FM, lower level. I know areas to be knocked for you guys to survive. Bye.